Good morning and welcome to the Prescient Equity webinar for the second quarter of 2023. My name is Natalie and joining me today I have Bastian and Seeiso. Global markets generally gained for the first quarter, with developed markets being propped up by strong US growth and emerging markets seemingly held back by disappointing numbers out of China. So the US just released their Q2 data, which, as mentioned, showed stronger than expected economic growth and tighter than expected labor markets. So what does this mean for SA equities? It's quite a tricky one because on one hand it could mean strong, more global growth, and on the other hand it could mean more inflation, but subsequently a more hawkish Fed.
Good point, Natalie, and thanks also from my side to everybody for joining. Good data is still good news globally for South Africa. We've got a very high, our economy has a very high beta to the global economy. So with that, more global growth means more growth in South Africa. Plus, we must also keep in mind that most of our equities are pretty global, so they are directly linked to global growth. So, I do agree it is a bit of a tricky one because higher global growth often does mean more global inflation, and with that comes often a tighter Fed. But right now, where we are in the cycle, I think we've been through the peak of the hiking cycle. And inflation is also coming down and actually not going up. So actually quite good news that we get more stronger growth from the States.
So what are the main driving factors behind this strong US growth that we're seeing?
Okay, it's quite a few. So that's encouraging things getting. The data is still mixed. For example, we had quite weak industrial production as of recent, but we've got strong retail sales. So the data remains mixed, but bit by bit gets stronger. And what we had more not just as of recent, but throughout the year, the theme has been that we've got a very strong labor market, and with that a quite strong consumer. And that picture keeps on reiterating itself, and the US economy is just not behaving like an economy which is on the brink to a recession anymore, which is quite good news. I would like to show you that quickly. Okay, as always, when we look at global growth, we like to focus on the present economic indicator and see what kind of picture the present economic indicator is showing us. The present economic indicator is our own in-house nowcasting, and we're going all the way back to the 40s. So I'm going to zoom in a little bit for you to just make it easier to see. So if I basically take out the early 40s, 60s, 70s, 90s and go all the way into the 2000s, you can see quite good that we are fast to track all the global crises. And this is basically the great financial crisis. Then we've got the COVID crash, the recovery, and now the slowdown, which we always expected to be not too deep because the data just never supported that thesis. And what you can see as of recent is that we've seen a spike in the present economic indicator, so basically telling us that economic growth is starting to pick up again. So let's look one level deeper. Just look at the input variables of the present economic indicator. You can see it's all kind of data: survey data, labor market data, production data, trade data, but also alternative data like electricity or gas consumption, railway or port traffic. All of it gets into the system, gets consumed, and then we make sense of it by trying to see how does this data track basically global GDP. And what you can see in this line is that the red line is the present economic indicator, the blue line is real GDP. You can see they track quite closely. The difference is that the present economic indicator gives us unrevised and more recent data. So if I now draw a regression line between those two to just compare what exactly should we be expecting given the state of the present economic indicator, you can see that with the current level of the present economic indicator, you could actually expect GDP growth in the States of above 2%. So that is a little bit of a contrarian, almost an outlier call, quite optimistic. But what is quite clear is that we're not headed towards negative territory. And then we're definitely seeing a quite more sustainable growth story than what we saw earlier at the year. But Natalie, let me also take up your second question on inflation. So I just want to drill into US inflation. Quickly, I mentioned that's coming down. So without going too much into detail, just going to start by plotting inflation through time. And as you can see, we are really coming down from the peak of 9.1 all the way to below 3% now. And by the way, the expectations for this year are that inflation will continue to come down further.
So yes, inflation is coming down, but core inflation remains sticky. And the Fed likes to use this as one of their indicators when making monetary policy decisions. So it's quite key to understand the driving factors behind this. So can you maybe elaborate on what exactly is driving core inflation in the US and why we aren't seeing any moderation here?
That's a good point. So yeah, I would love to show you that. You are right that core inflation is remaining sticky, but we once again have to understand the drivers thereof. Okay, so you're right, Natalie, that core inflation actually has remained sticky, but let me just go into that a little bit deeper and decompose US inflation. So this is just a composition of the basket, which I'm going to skip. And now looking into core inflation, you can see that, yeah, this is the total level. Now we've zoomed in on the x-axis already quite a bit, and it's coming down sharply. So what is sticky here? It's definitely not anything linked to the oil price. So you can see motor fuel is deflationary. So that's basically where you can see the lower oil price coming through. So there's no problem here in top line inflation. But then we've got this big element here, shelter, which is the red bars, and they keep on growing. And shelter is a part of the core basket, while the oil price or everything linked to the oil price is not. So let's do the same analysis, but now we do this for core inflation. You can see that now if I look into the total level of core inflation, it's not coming down sharply enough, and that's where the concern often sits. But again, let's zoom in on shelter. Shelter is the key driver. So if I take shelter out of the equation, you can see core inflation is actually coming down quite quickly. And with that, our worries of core inflation being very, very sticky should actually go away. So the key question now becomes obviously, okay, what happens to that shelter component? And I'm going to show you that quickly as well by looking into the US housing market, which is just something very important to observe. It's going to switch off the house prices, of the changes in the house prices, and bring in owner's equivalent rent and the rent of the primary residence. So those two are the core drivers of the core inflation, shelter bucket in the core inflation bit for the states. And now if we overlay US house prices, you can see that the time series don't really look to or seem to follow each other. But if you shift the yellow time series to the right by 12 months, they follow each other almost by perfection. So with that, owner's equivalent rent and the rent of primary residence would be expected to come down sharply, almost potentially into negative territory. So I'm going to overlay those two time series now for you to just show how perfectly they track as soon as we shift the yellow line to the right. Okay, so we can see the yellow line here now has perfect match to the red and the blue line. But if we look into real time, you can see that the yellow line has come down sharply. So yeah, with that, expect the shelter component to come down sharply. With that, expect core inflation to come down sharply. And with that, expect more good news going forward from the Federal Reserve.
Thanks, Basti. So you showed us the core inflation and how the US housing market is linked here. What about the US labor market? Does it have any impact on inflation, or is there any link there?
Yeah, that's a good question again, Natalie, because obviously a strong US labor market generally leads to a stronger consumer. Stronger consumer is able to push up house prices, and that's a little bit of the conundrum which we at the labor market looks extremely strong, continues to look extremely strong, not in line with the economy which is basically a recession or close to recession. But luckily you've seen the house prices coming off. So the soft landing which the Fed is trying to engineer looks like to be happening, and that's good news. So I want to show you two pictures on the labor market, but we would interpret those as positive because inflation is coming down and even core inflation is coming down. Okay, so just to drill into that labor market a little bit more detailed, just going to show one quick chart, which is a heat map of the US labor market. So what you can see on the x-axis, different metrics of the strengths of the labor market. You can see metrics like underemployment, unemployment, wage growth, prime age participation, labor force participation, etc. So I'm not going to go through all of them. And then we have basically Z-scored them to make them, just to normalize them, to see if we have outliers on the upside and the downside. White would be neutral, red, as always, with Prescient would be negative, and blue, Prescient blue, would be a positive indicator. And you can see, just if you follow on the heat map, a lot of red, obviously, after the great financial crisis, a big shock here, short shock, after the COVID crash. But as we speak, you can see that most indicators are in the dark blue. So very, very low underemployment, very low unemployment, very high wage growth. Good participation when one looks at the prime age labor force participation rate. The only red indicator here is the labor force participation in general, but you can see that we see a trend over the last 2 decades from blue to red, which is much more structural, driven by an aging population. So if I strip that one out, everything is in the dark blue. So yes, we have this super strong labor market, but again, I want to step away from the narrative that bad news is good news because the Fed defines everything. I want to say that as soon as inflation comes down and the Fed has room to maneuver, strong economic data is good news, and especially for emerging markets like South Africa.
So if we're in an environment where we have higher growth and lower inflation, where does this leave our stance on SA equities? Would you say we're bullish?
Not quite. So that would be the right interpretation if we would only use those 2 metrics, those 2 macro variables. But then there's more to it. We have other macroeconomic variables which are not all that encouraging. And we do have a Fed which is still tightening the screws. So yes, our take is that will stop here and inflation is coming down, and that will give the Fed room to stop. But there is more to it when I look into our view on SA equities. Okay, so what is our view on SA equities then? As I said, there's more to it than just some macro data. So you can see that we are arriving at a neutral stance, which is not a bad score given that the overall stance on equities is generally more on the cautious side. So let's drill one step deeper and see why we are at a neutral. And this quite stark barbell where we see a very attractive valuation, so a cheap market. The economic picture not terrible, that's what we alluded to. The Fed, or not the Fed, but financial conditions are more than just the Fed, but financial conditions in general tightening, but as mentioned, not that tight, with the Fed now also able to maneuver a little bit more flexible. But then the strong detractor is really on the sentiment side. So let me just zoom into this one, and you can see that all our sentiment indicators, business sentiment, consumer sentiment, and investor sentiment, are quite negative for SA. And I mean, that should not come as a surprise if we arrive at the own goals which we scored over the last couple of months, which with deeper levels of load shedding and allegedly selling weapons to Russia. That obviously is problematic from a business, consumer, and investor sentiment. Okay, but to even take this one step further and look into our view on SA equities slightly more detailed, again, mentioned earlier, we are arriving at a neutral score here at the top, but if I look at the positioning through time, you can see that we have been positive over the last 2 years, and it's only this year that we took a much more cautious stance. And our indicator set is now starting to improve given what we have basically described. So we do not see the end of a bull market. It's not the beginning of a recession, the end of the bull market. So there might be opportunities in SA equities from here. And what I also want to highlight is looking into our alpha engine. I mentioned earlier that we are at the peak of the hiking cycle. With interest rates potentially coming down again, that is the exactly perfect environment for our core equity strategy. Seeiso is going to speak to that obviously much more in detail.
So Basti, you mentioned that we may be at the peak of our hiking cycle. So let's chat about how this could affect our portable alpha outlook. Seeiso, what is the potential to earn positive alpha now in this environment? And maybe just start on the global side.
Yeah, thanks Natalie, and thanks everyone for joining. So the great news is that we've always said that base rates increasing negatively affects our portable alpha. What we'd ideally would like to see is high and stable rates, but base rates declining if we're truly at the peak of this hiking cycle is also very good for the portable alpha strategy, particularly in the short term. And there's 2 reasons why this is the case. So we have the funding side of our portable alpha strategy, which is essentially the rate that we pay to get the unfunded equity exposure. That's currently in the offshore space that references the secured overnight financing rate, the soft R, and that's sitting at around 5%, or just north of 5%, with very thin spreads, about 10 basis points. So very cheap funding. And then on the yield side, which is where we invest the cash, fixed deposit rates for 12 months in US dollars are being quoted north of 6.2%. So that shows how attractive it is to lock in that fixed rate and funding at a particularly low rate. And this is a particularly strong story, as you said, where funding rates are coming down and you've locked in this high spread.
All right, like I said, so there's quite an attractive spread if you just look at some of the more the very risk-free assets, such as the fixed deposits, where there's absolutely no capital risk relative to funding rates, which we said is essentially the rate that we earn on margin. And we obviously don't just invest all the cash in fixed deposits. We have a wide array of instruments that we can use, and to decide which is the most efficient combination of these assets, some of which are floating rate in nature, we have constructed this efficient frontier, and this then gives us the most optimal combination of assets that gives the highest amount of return for a given level of risk. So that being said, even though you can earn a healthy spread by just investing in US dollar deposits over what we're financing, we have a robust process which combines all of these assets to give us the best possible outcome for each amount of risk that we take.
So looking at all the different fixed income asset classes on the efficient frontier that you've just shown us, it looks like there's much more additional return on floating rate bonds and ultra short investment grade credit instruments as opposed to the fixed deposits. So why not rather put all the assets in there?
Yeah, so the key consideration when coming up with this framework, and particularly in the portable alpha world, is risk. So we need to have risk management at the heart of what we do, and we cannot simply put all the cash in one specific asset class because of concentration. That's why you'll notice, like you said, the floating rate bonds are above the efficient frontier. The efficient frontier is constructed with the constraints we have on each asset class. Okay. Secondly, we have a very systematic risk measurement tool that we use to assess the overall riskiness in the market. We essentially look at a combination of credit spreads, which is just a fancy way of saying how much credit risk or how much risk is in the markets. And we use this tool to determine what is the optimal allocation between your fixed deposit assets and your floating rate assets to balance out the overall duration in the portable alpha strategy.
Okay, so like I was saying, we have these 4 spread measures, which basically give us an indication, or we use to get an indication of what the overall risk in the market is like. And if I just switch them on, we have the investment grade credit spread, high yield credit spread, South African specific credit default swap spread, and then overall emerging market spreads. So we take this information, and what we do is we distill it into this dual risk indicator, where on the x-axis we have the level, and then on the y-axis we have the slope of the spread. So the red dots indicate essentially where there's a high amount of the level of the credit spread is quite high, but also it's increasing at a fast rate. So absolutely bad for the portable alpha strategy. And then on the blue dots, we have the good scenarios for the portable alpha strategy, where spreads are high, i.e. there is value in taking on risk, but importantly, that risk is coming down. Now, what I want to focus on is where exactly we are. So you can see we're firmly within that blue area, which means that the current environment for the portable alpha strategy is quite favorable. We still have elevated spreads, higher than average, but importantly, the direction of that spread is downwards, which is important for portable alpha strategy and is reflected in our current positioning. So if you look at our current positioning in the offshore space, we have about 30% of the funds cover assets in those fixed deposits, and then it's balanced out by a very diversified array of floating rate instruments that earn a decent credit pickup.
So it sounds very positive and certainly a very compelling story for offshore equities. Let's look at it in the local context. So we've just had our June inflation print come out. Inflation is now within the target range. And this may mean that the SARB is also at or near the end of their hiking cycle.
Correct, yeah. So if we look at locally, we get a very similarly positive picture from a portable alpha perspective. And it's the same two factors. If we consider what the funding spreads are like in the local space, they've remained relatively constant. We just went through a June futures closeout, which was relatively benign, despite the typically high dividend uncertainty in the September contract. And then if we look at the funding side, if we look at the yield side of the portable alpha coin, we have NCDs, 1-year NCDs, which are essentially just deposits, also yielding at really attractive levels. And I would like to show you this on a chart. But essentially, we have the two forces working to increase the attractiveness of this portable alpha strategy.
Okay, so as I was saying, if we look locally, we see a similarly positive outlook for the portable alpha strategy, especially if we consider 3-month JABA, which is of course the funding rate that we're linked to in the local space, and compared to one of the safer cover asset instruments, which is just a 1-year fixed rate NCD, we can see a very healthy spread, which is part of the positive outlook that we have on the strategy.
So we've seen many SA-specific shocks to the market over the last quarter, as well as elevated volatility in the fixed income markets. So how has the fund performance been?
Yeah, that's a good question. Given the amount of volatility we've seen in the fixed income markets, and of course that directly translates to the alpha that we get over the equity market performance, the funds have held up relatively well. So I think Basti mentioned it earlier. We had a few very specific and very deep shocks over the last quarter. We had a global risk-off sentiment with the US debt ceiling debate, and then we had SA-specific issues with the whole diplomatic fallout between SA and the US on the back of the Russia arms debacle. Because we have this robust risk management in place, and we simply don't just pile into fixed rate instruments, which would enforce the full force of the mark to market on the performance. We have a balanced alpha profile, and I'd like to show you a couple of charts just to show you how that performance has played out over the shorter term and also over the longer term.
Okay, so I just wanted to pull up quickly one of our portable alpha portfolios, being the Prescient Equity Top 40 portfolio. This is the A1 fee class, and what we have here is the percentage of time that the fund has spent in each quartile relative to its peer category. And you can see over 3 months, the portable alpha strategy can be quite volatile and is quite well spread out between the various quartiles. But as you go longer, if you look at the percentage of time that the fund spends in each of the quartiles over 6 months, 1 year, 2 years, etc., you can see that for the majority of the time, the fund, if we look at over a 10-year period or 7-year period, 67% of the time the fund has been in the first quartile over 10 years, and then 47% of the time the fund has been in the first quartile over a 7-year rolling period. So again, just to reiterate, given the shocks that we've had, we can see them sort of displayed in the 3-monthly quartile distribution, but over the long term, the performance remains solid and robust.
So you're very bullish on the portable alpha strategy, but let's discuss some of the potential risks to your outlook, as well as how you might go about mitigating these risks.
Yeah, so naturally, there's always risk to any outlook, and I think the biggest risk to the outlook would be further idiosyncratic shocks to the SA fixed income market, like we've seen. But the main tool that we have to mitigate against that is obviously our robust risk management, and at the center of that risk management is diversification and then scenario analysis. So I'd like to show you some of the scenario analysis and illustrate just how we have positioned the portfolio to guard against any of these risks to our outlook.
Okay, as I was saying, we have quite a number of tools to help us map out the various scenarios and therefore mitigate against any risk to our outlook. What we have here is a very simple but comprehensive scenario analysis tool. What we're looking at is the expected returns under various rate outcomes for money on call, 1-year floating rate notes, and 1-year fixed rate NCDs. And what we can see here is that if rates remain relatively flat, there's nothing to call between 1-year NCDs and 1-year floating rate notes. But as soon as we start to see further hikes, which would, again, like I said, would be a risk to our outlook, then the floating rate notes start to outperform. And this is the reasoning that our positioning will have a component of floating rate instruments to mitigate against this sort of outcome.
So it seems like we're at a good point in the economic cycle, a good point in the interest rate cycle. We've had a lot of idiosyncratic shocks, which the funds have done really well with the good risk management that we have in place. And you seem quite optimistic about what's to come. So how has our new Prescient Equity Fund done over this last quarter?
Yeah, so you're quite right. I think this is a quite opportune time in the cycle, also given what's just what the economic markets have just done. I think that the new equity fund, which is peer cognizant and benchmarked to the peer equity group, has done phenomenally well. It's got a great start to what will be a long track record of outperformance, and with the portable alpha strategy being in a opportune point in the cycle, I think we can expect nothing but great things from that fund.
Definitely something to look out for in future. Yeah. Thank you, Seeiso. Thank you, Basti. And we will now take some questions. Welcome back, and thank you for sending through your questions. We'll just jump straight in. So our first question we have on the Fed meeting yesterday: has the Fed meeting last night had any impact on your view on equities?
I'll take that one. Not really any impact there, because the Fed meeting last night was actually pretty uneventful. More of the same, so to say. They didn't rule out any further hikes, but also didn't commit to any further hikes, nor did they speak about carbon to be at the end of this hiking cycle. And with that, at the end of the hiking cycle, that's actually where always uncertainty peaks. So you need to now see first what the implications of all the hikes which we've seen earlier this year and last year. And that's why the Fed wants to observe. And it makes sense. And at the same point in time, we do have 2 labor market reports and 2 CPI prints before the next Fed meeting. So they obviously want to look at those first. That makes perfect sense. What they did say, and that's exactly in line with what we have just been speaking about, that our present economic indicator doesn't suggest that there's a recession around the corner. So basically backing our story here, which is great, obviously.
Thanks, Basti. So this one kind of follows on from that question. Are the implications of last night's Fed meeting good or bad for your portable alpha strategy?
Okay, so I'll take that one, Natalie. So it looks like we're very close. Or like I said, what we ideally want to see is rates remaining high or coming down drastically. That really fuels our alpha engine. And what worked against us last year was that the hiking cycle was very unpredictable, and that was just because of the inflation surprises that we kept seeing. And if you look at what's been happening this year, inflation has been coming down, indeed softening, which has put the inflation bears at bay, and therefore bodes really well for our alpha strategy. And then if you remember last year, even with the inflation surprises and the very unpredictable hiking cycle, we still managed to end the year in positive territory in terms of alpha. So given that that uncertainty and the unpredictability of the hiking cycle is now dissipating, we should definitely end the year again in positive territory from an alpha perspective this year.
Great. Okay, what do you see as the biggest risk for equity markets for the remainder of 2023?
I guess the biggest risk for 2023 for equities generally, that applies to South Africa, but also to global markets or emerging markets, global emerging markets, is obviously now that the Fed is overdoing it. So we are at this peak or very late stage of the hiking cycle. They are cautiously observing the data. They haven't ruled out further hikes. We are getting in very restrictive territory here. They even said that. So Powell was quite clear that he sees, even on a real basis, that we are in restrictive territory now. And with that, obviously, there's a risk that they continue the hiking for too long. That's always the risk at the end of the hiking. The Fed being the biggest risk is nothing new. That's where we're at quite often. Another potential risk would be that we're wrong on the economic call. So that soft landing or no landing story starts to become more consensus. And what if the data turns? I mean, we're quite confident at Prescient that we'll pick that up quite quickly with our real-time nowcasting tools. But the reality is, once an economy turns, it's very hard to turn it back. And there's a lot of nasty self-reinforcing cycles which can be set off. And that can always happen. As said, we don't see that yet, but that's something to look out for. So tracking the data and analyzing it and scrutinizing it on a daily basis will obviously remain key.
Thanks, Basti. The dollar seems to have taken a bit of strain recently, which suggests emerging markets are well poised. What offerings do you have on this front?
Yeah, okay, I'll take that one. So definitely, I mean, with inflation finally coming down and seemingly rates stopping to the rate hiking coming to an end, it puts the carry trade back on in terms of the currency, which is why the dollar has been taking a bit of strain, and obviously that bodes very well for emerging markets. So investors looking for yield will sell dollar-based assets and then invest in emerging markets. And to this end, we do have an offering for emerging markets. We've structured our portable alpha equity offerings such that investors can get access to pretty much any beta that they would like. So we have a MSCI developed market fund, and we have an MSCI emerging market fund as well, which runs on exactly the same strategy. All that's different is the beta. So if you want emerging market beta, can give you that in a pure form with portable alpha on top of it. Developed market the same. And then what's great about that also, structuring these two products in the UCITS environment, is that we can also offer an all country offering, not in one vehicle, but by essentially combining the two funds in similar proportions to what the all country has, which is typically around 90% developed market and 10% emerging market. You get that offering as well with the portable alpha embedded in there. So yes, short answer, we do have an emerging market fund that runs exactly the same strategy, and you can combine that with the developed market if you want the all country as well.
Okay, thanks, Seeiso. SA and USA will have elections in 2024. How do you accommodate the risks associated with this in your management?
That's a good question. We get that very often, especially if you run a systematic data-driven investment approach. Common question is, how do you incorporate political events? The answer is, we don't make predictions based on political outcomes, and we don't make predictions around politics in general, but we do capture the implications of such events by looking at market-related data. So we can use, for example, slopes of yield curves, slopes of volatility surfaces. All of that basically paints a clear picture what the potential implications from an election, either in the States or in South Africa, could be. And to take it one step further, we obviously also scrutinize surveyed data. So basically consumer confidence, business confidence will be heavily impacted if the odds of a negative election outcome in South Africa, for example, increase. We'll pick that up immediately in business confidence, which is one of the key indicators we use. And then there's investor sentiment, which we've spoken about earlier. In fact, we showed implications of political events being captured by our models very quickly. If we look at the Lady R story, or Russiagate as we call it, you can see that our indicators are fast to pick it up because markets react fast. And that's a much better way to do it than me having a subjective view on whether Trump or Biden will be elected. And even if I would know that, what the implications thereof are very hard to predict. So that's why we always go with the data, with the evidence. And that really gives us a good guidance on how to position ourselves.
Thanks, Basti. So that's all the questions for today. Thank you, everybody, for joining us, and have a great week further.